love letters from the IRS. Have you received one of those? 11 million Americans have received a little love letter from the IRS, a significant increase in those letters that are being sent from the IRS over prior years. So we're going to talk about what to do if you got one of these letters. Now, these letters aren't an audit letter. They are a math error letter. Math error. Well, if I'm using software, how could it be a math error? I'm pretty sure the software is going to add and subtract appropriately and calculate my tax revenue. So we're going to tell you what's going on with those letters and why there's been a significant increase, and if you get one, what you need to do. Coming up on the program this week, along with the fact that we welcome you to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Central Florida's longest running radio program, coming to you on a variety of networks throughout the Central Florida region. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning. So I can't let this go without at least taking a moment and recognizing, my goodness, yesterday, hard to believe, 20th anniversary of 9/11. It's just if you were around during that period of time, you just know the shock. I remember I was at the office when all of that was happening. I wound up coming home. My wife was pregnant with our first son. I mean, it's just just amazing when you think back on just how dramatic that period of time. And it's also just incredible how fast 20 years goes. And for that matter, and the Wall Street Journal had a great article kind of talking about this notion, but it's been 20 years, and for the most part, there hasn't really been a significant event like that, and certainly let's hope that there isn't another one over the course of the next 20 years, or really over the course of our lifetime. One of those kind of Pearl Harbor-esque type of events that just kind of comes out of nowhere and really kind of changes your sense of security. So our thoughts certainly go out to all of those folks that lost loved ones and were impacted. I guess that's probably true of everybody, was impacted by the events of 9/11. So important to kind of remember those, particularly to maintain perspective on world events and what's going on out there. So interesting article, as we mentioned, in the Wall Street Journal yesterday, sort of talking about some of the things that we've been able to do as a country over the course of the past 20 years to sort of keep all of that at bay. So we encourage you to kind of read that. If you're looking for something to read today on Sunday, while maybe you're waiting around until kickoff or something like that. So there's a good article to kind of read after you finish listening to this program. We are, of course, excited for the week ahead because it marks somewhat of a return to normal for us at the office. And we really are excited about it. Each quarter, if you're a client of Nelson Financial Planning, you know that each quarter in normal pre-pandemic times that we have a series of events. And so these are purely educational events available to our clients for them to come in and listen to particular investment folks in the industry. Maybe it's an economist, maybe it's a tax expert, maybe it's a portfolio manager, whatever the case may be. We'll bring in different people during the course of the year. Each quarter, we would have one of those educational events, typically at the Country Club of Orlando, big ballroom there, all that kind of thing. Obviously, we haven't had any of those for the past 18 months. Shifted to conference calls and fine substitute, but again, not the same thing as having an event live and in person. So we're leaning into it. And we particularly made these reservations, booked these rooms back in June when it looked like the numbers were really getting much, much better. And then you had the Delta variant. But it looks like maybe we're on the better side of that surge, if you will, now. And so we're hosting it. We're hosting a group meeting. We've done a variety of things differently than what we've done before. We're breaking the event up over 2 nights, so it's exactly the same event. It's going to be this coming Thursday and then the Thursday after that. So exact same event, exact same presentation, and in a much bigger space. We've sort of changed the venue as well to have a much bigger space. Less seating at each table, more social distancing, if you will. 2 bars, that's important as well. If you go to any event, there's going to be 2 bars rather than 1 to just kind of reduce down the typical line that can form at those types of events, grab and go name tags, things like that. So bottom line is we've spent a lot of time sort of reimagining what those events look like, and we are very excited to bring those back. I know a lot of our clients have been sort of clamoring for that. We too at the office have been clamoring that. So very excited about this week being able to kind of bring those events back. And a great topic. We're going to be talking about the 10 principles of long-term investing resilience. So we're going to have a lot more about those principles on the program next week, but certainly a good time to sort of recap, especially after sort of an absence of those live in-person events that we like to do for a year and a half. So, but next week we'll certainly sort of recap some of the underlying concepts. Speaking of the week, the week that just passed, markets started to show some concern over the nearing end of easy money from the Federal Reserve, right? We all know it's going to happen. You can't keep interest rates this low, particularly when you're looking at inflation at 5%. And so ultimately what the Federal Reserve is going to have to do, and what they're going to start to do, is that they're going to engage in tapering of their bond buying. Now, what is that? That's them going into the market. That is them buying U.S. government bonds in an effort to keep interest rates down low. They are doing that to the tune of $120 billion per month to keep interest rates low. So ultimately, that's going to happen to start to change. And so you may see the markets react. Not dramatically this past week. It was a decline of about 2%, but for each one of the days, it was a decline. So that's the first time that's really happened since February. So nothing too dramatic, but just certainly something that investors want to be aware of, and particularly rebalance their portfolios before things get too dramatic out there in terms of interest rates. We're going to take a break. When we come back, we're going to talk about these IRS love letters coming up next here on Dollars and Cents. So did you get a love letter from the IRS? 11 million Americans got these letters, all part of this unbelievable slow process that folks are running into on their processing of their 2020 returns. I just was talking to someone just the other day, submitted their return timely. Matter of fact, they were like, wait a minute, did I forget to do my tax return? I haven't heard anything about what was going on with the normal refund that I get each and every year. And the reality is that there's a lot of tax returns that the IRS is sitting on because they just are so far behind. And now as they start to go through them, they're issuing out these quote unquote math error notices. And the frequency of these has really accelerated, particularly in comparison to last year, which isn't necessarily a great comparison because obviously with the pandemic, they were very much behind schedule, not able to work remotely, things like that. It's a 14 times increase though over last year. If we go back to the year before, just for comparison purposes, it's about 5 times greater. So again, a pretty significant difference on the amount of notices that have been coming out from the IRS. And these notices they're not audit. They're not an audit letter, but effectively they change your taxes, and so they're described as math error notices, but it really has to deal with something much, much more than that. So in this segment, we're going to talk a lot about what you can do if you got one and how ultimately it will work and what's the root cause of all of these letters. So we welcome in our listeners across Central Florida on the variety of radio networks that we're on, whether it's News Radio WFLA Orlando, 96.9 The Game, good Bucks win on Thursday for our sports fans, and then of course over on the Space Coast at 92.7 WMMB. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. So these letters, they're not audit letters, and so the IRS isn't asking you to submit financial information, or they're asking you to generate a bunch of paperwork back to them. It's just saying that some of the calculations, if you will, were not accurate, and so they're just going in and they're adjusting it. And so the problem is that the first notice often is the final notice, because they say it's a math error, right? Then they're going in. They're not necessarily questioning what you're telling them. They're not looking for additional information or additional documents, but because they treat these as math errors, and this category of IRS notification has long been a category of issues. Back when it was created in the 70s, it was meant to help the IRS just quickly resolve easy items. But in the 70s, people were in fact doing their tax returns much more by hand. And so consequently, you did have a lot more math errors when you're reviewing tax returns. Today, 95% of those tax returns are done electronically. So it's not like the software is, doing some bad math on it, but they still use these as a means of addressing issues on people's tax return. And what happens with that is that you really don't have much of an ability to argue about what's going on this notice. And so a lot of these notices, and it's estimated that well over 80%, so pretty much the entire increase over prior years, has to do with the economic stimulus checks. Those checks that we all got to try and offset the impact of the COVID pandemic. Well, those checks are the ones that are generating a tremendous amount of these notices. And the biggest reason that we see is that people sort of forget or don't recollect, or maybe they didn't see the check in the mail, maybe they didn't balance their bank statement that month, whatever the case may be. These math notices generally relate to folks that are trying to claim the stimulus payments that didn't actually get the money. The problem is that you can sit there and say, hey, I didn't get the money, I didn't get the check, I didn't get the deposit. But if the IRS records show that you did, well, then you're kind of out of luck in terms of how you're going to be able to argue that. Certainly, you can pick up the phone and call them. Good luck with that. It's estimated that only 8% of the 173 million calls to the IRS that happened in the first 6 months of this year actually got through to an agent. So 8%. So your odds are less than 1 in 10 that you're going to be able to talk to somebody when in fact you call the IRS. And the crazy thing about these math error letters, particularly this group that's being sent out, is it doesn't really have a whole lot of information. And in fact, 5 million and 11 million didn't even have a proper description of the response time that you were allowed as a taxpayer. So for those 5 million and 11 million, it's like 50%. Those 5 million, those folks are getting new letters with new language that ultimately gives them more time. But we start to think about it's kind of crazy. These math error letters have been around since the 1970s, and here we have the IRS sending out just a slew of them this year, and not even really letting taxpayers know what their rights are when they get that letter. So here's what your rights are. When you get that letter, you've got 60 days to request an abatement, to respond to that letter. You can certainly provide additional documentation, but here's the tricky thing about the economic stimulus checks, right? Your documentation is the fact that, hey, I didn't get the check, I didn't get the money, I don't have it. How do you prove that? How do you prove a negative, right? I mean, that's really hard to do. So it's not like there's some documentation that you can send to the IRS. So these letters really have folks in a pretty tight spot, particularly when, according to the IRS, if you don't provide additional information that justifies the reversal, again, how am I going to provide information about a check I didn't get? And they believe, the IRS believes, that the reversal is in error, that you're basically claiming and you got nothing to stand on, then they may forward your case to audit. Well, that's a great situation to be in, because with these math error notices, because of that mechanism, it goes directly to their collections department in a much faster, much quicker way. Now, there's no great answer on these, folks. The reality is, if you get a math error notice, then you've got to really take the time to carefully go back through your bank deposits to just see and confirm whether you got that money or not. And then you've got to do something. If you don't agree with it, and obviously you don't because you just filed a return that says, hey, I didn't get the stimulus check and I would like my stimulus check because I'm entitled to it just like everybody else, then you've got to really carve out some time to try and get through that 800 number to the IRS. And I know it's crazy, it's impossible, only 1 out of 10. That means you got to make the call 10 times in order to get through to talk to somebody. But there's not really a lot else that you can do in this particular situation. You can certainly write them, you can certainly do that, but the risk there is, again, that if they don't think your information justifies the reversal, then there's a higher likelihood that they're going to send it directly to an audit. And for something like this, that's just not anything that you want to find yourself involved in. So understand that this problem isn't going away, because we've got another stimulus check for this year, and then we also have the advanced child tax credits, which are extra cash that folks are sending, that the IRS is sending people on a monthly basis. So you've got a lot of different things, a lot of payments that are coming out, that it's really going to be a function of, well, I didn't get the money, but the IRS says I did. Now what? And the only way to resolve that is really to be patient and go through that process of trying to talk to somebody, because the window of time that you've got to address this is very short. It's only 60 days. And if they don't think your information that you're sending them justifies the reversal, they could very well send it to audit. And the reality is, how do you provide information that says, I didn't get the check? That's the hard part about it. So just be aware, if you got the letters, that's what's going on. The information they give in these letters is very, very lacking. So you really may be scratching your head. But 9 times out of 10, what these letters involve this year is that economic stimulus check. So really take the time to dig back through and see whether you got it or not. And then ultimately, you're going to have to go through that process of calling the IRS. There's no other way to do that, given the consequences that occur if you ignore it or if you send back information that doesn't really add anything to the picture. So we're going to take a break. We come back from the break, we're going to talk about whether you're waiting too long to tap your retirement savings. Interesting topic coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Are you waiting too long to start tapping your retirement savings? According to a recent survey from the Employee Benefit Research Institute, it's estimated that 80% of retirees don't touch their IRAs until it's time to take their required minimum distribution. That age now is 72. A lot of conversation in Washington, though, about increasing that age to 73, maybe even 75. I don't know. And I often don't say this, but particularly when we kind of quote research and data and stuff like that, I just don't know if that's quite an accurate description of what happens for most retirees. I just don't think that the vast majority of people, particularly when you stop and hear the fact that there's a retirement crisis and not many people have saved enough money for retirement, that you've got 80% of the people waiting until their required minimum distribution before they take any disbursements out of their retirement accounts. The reality is that when you retire, you start taking income from your various investments, that really does count towards that required minimum distribution. And maybe you don't have the required minimum distribution because you're not quite of the right age, but if you're taking money out, it's a retirement distribution. The required minimum distribution is not some extra amount that you've got to take out beyond that. It is, in fact, the minimum amount that you must disperse out. And it doesn't matter how you're doing it, whether you're taking it out in chunks here, chunks there, or whether you're taking it out as monthly income. The reality is that required minimum distribution, I think far more people wind up sort of satisfying that by the natural course of action, particularly when you retire. But far more importantly, and to the extent that there is a portion of the population that is waiting to take money out of their retirement accounts for their required minimum distribution age, let's just recap some of the rules that apply that have fundamentally changed the game, if you will, on how the distribution of money works, particularly on the taxation side of things, because the rules of the game really have changed when it comes to your retirement accounts. And of course, the biggest change is one that we've certainly talked about before on the program, but there's no longer the stretch IRA. And I think we are just beginning to understand or comprehend what that rule change really means, because that was one of those things that was snuck in about a year and a half ago in the Secure Act that was passed back in January of 2020. And then, like 6 weeks later, big giant pandemic breaks out. So you didn't really have a whole lot of conversation about that. And certainly didn't have a lot of conversation about the impact of that. But when you eliminate the stretch IRA and flip that to a 10-year rule, that fundamentally changes how you want to be thinking about the types of accounts that you have. So again, to the extent that there's sort of a larger group of folks who say, I'm not going to take anything out of my retirement accounts because I'm going to just wait until I'm forced to do that, you really may want to get out of that mindset because of these changes. So just to recap, prior to January 1 of 2020, when you inherited a retirement account, you had the ability to spread out the distribution of the money in that account over the course of the rest of your lifetime. The IRS had life expectancy tables that you could then go and calculate. And basically it meant that you might have to take out 2 or 3 or 4% of the account, but you could leave the rest of the account continuing to grow on a tax-deferred basis. And as long as you took out that little bit of money that you had to each and every year, then the rest of the account could sit there and continue to grow on a tax-deferred basis. All of that has changed. That does not exist anymore. What exists is a 10-year rule, which means that you got to take that money out over a 10-year period of time. Now, with the 10-year rule, it doesn't mean you've got at least a little bit of flexibility in that you don't have to take out the same amount of money each and every year for that 10-year period. You can wait it all to the end or take some now and then take some later. You've got a little bit more flexibility in how you take that money out over a 10-year period of time. But let's face it, a 10-year period of time is a much shorter period of time than the rest of your life expectancy, which, oftentimes there was a trick that you would use to maybe name grandkids as beneficiaries of retirement accounts. Well, stop and think about that. Some 20-year-old kid inherits an IRA account and he's got the rest of his life. IRS tables say that that's like another 70, 80 years. Imagine how much tax deferred growth can go on that account. Of course, that also means that money's not getting taxed, which again gets us to why that rule changed. But here's the point. With the 10-year rule, it now becomes a discussion of, well, wait a minute, what bracket might my beneficiaries be in, and how might this affect them? Because if you're still working and you inherit a retirement account and you've got to take that money out over a 10-year period of time, well, then you're just, now all of that extra income is coming in at the highest possible tax bracket. So you're going to wind up having a much larger share of that sort of chewed away and sent off to the IRS. So from the owner of that account perspective, you may very well be better off, leaving your beneficiaries what we would refer to as non-IRA or non-qualified assets, whereby those are after-tax money that winds up not having any tax implications on it when folks inherit it. So oftentimes, sort of under the old rules, what we would say to somebody is, well, let's take a little bit more money out of your after-tax or non-qualified accounts and just take what we need to out of the IRAs, because ultimately we're looking to reduce your tax bill, right? Because your beneficiary is going to have plenty of time to deal with the taxes on the IRA. And that may be what contributed to that statistic that we shared earlier. But I really do think that things have changed so much over the course of the past year and a half that more and more folks want to be reconsidering exactly where they're taking that income from, and not be looking to take as much or as heavy of a hit on the after-tax or non-qualified account. Because when you think of it, you really may want to start to take more of that in order to potentially minimize what the tax liability would be for your beneficiaries. So rules of the game have really changed there. When you hear that statistic, what strikes me on that is that a lot of people do wait, and that's fine. I don't know that it's 80%. That seems like a pretty high number. But to the extent that you're in that group that was waiting, and you had a strategy in place to help minimize your taxes, the whole thing is turned upside down. So bottom line is, you really want to sort of relook at where you're getting your income from, because it may now make sense to take more out of the IRA, even if you're not quite your required minimum distribution age. And even if you are your required minimum distribution age, you may want to take out even a little bit more than that required minimum distribution in order to address this tax issue that is first and foremost going to be an issue that folks are going to really have to start to wrap their hands around, because having that payment come out in a 10-year period of time is going to have a significant impact on people's tax return. Now, in response, a lot of folks talking about Roth conversion, and understandably so. Two big sort of butts there, if you will. You have to be careful with large chunks pushing up your total tax brackets. That's one of those things where you really got to kind of look at the numbers before you consider that. And then remember, after-tax money is after-tax money. If you've got after-tax money and then you're inheriting after-tax money, then there's no tax liability on that portion that is after-tax. So that can't fundamentally be changed. Certainly some of the rules involving Roth could. And so we lean more towards having that after-tax piece, particularly now under the new rules, whereby that's the piece to be preserved, to be left to the next generation, less so on the retirement account. So certainly something to think about, particularly if you're starting to think about retiring, taking income. Where do I take income from? Or if you are retired and have been taking income for many years, the reality of where you want to take that income from certainly has changed. It's important to be thinking about that under these new rules. We're going to take a break. When we come back, we're going to return here on Dollars and Cents with Joel Garris of Nelson Financial Planning. There's been an uptick in retirement this year, probably for a variety of reasons. I think a lot of folks, this pandemic sort of forced them to spend maybe more time at home, and ultimately they said, well, that's a pretty good thing. You're missing out on being able to be home and do the kinds of things that I might like to do beyond working. So that really is sort of contributing to this bit of an uptick, if you kind of look at the numbers in folks that are retiring. Others ran into this just this past week, a little concerned about the vaccine mandate. Everybody's sort of got a different perspective on that, and so that may also kind of force people to think about what they want their future to be. So we thought it would be good here in the last segment of the program to share with our listeners some of the things that you want to be thinking about before you take that jump, if you will. So welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Central Florida's longest running radio program, coming to you on a variety of networks throughout the Central Florida region. Of course, also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you subscribe to us on your favorite podcast or social media channel of choice. If you have any problem finding us on those platforms, either search for Nelson Financial Planning or go to our website at nelsonfinancialplanning.com. Upper right-hand corner, you'll see a bunch of icons. Click on the one that looks most familiar to you, and you will get directly connected to our platforms on that particular social media choice. Make sure you subscribe to us so you know when we upload new information. We're constantly, of course, putting the show up on those channels, but also other certified financial fiduciaries at Nelson Financial Planning are posting things, whether it be about taxes or retirement or investments. We always use those formats to add more timely perspectives in. So make sure you're connecting with us on those platforms as well. So obviously going into retirement is a big life transition, right? And I don't think folks quite appreciate just how dramatic it is, because you go through the process of 30, 40 years of accumulating money to get to that point, and then it really does reverse itself, because then you could spend 20 or 30 years spending out that money over the course of your retirement. So that shift from accumulating to spending is a pretty significant one. And obviously, you want to make sure that you have an understanding of what expenses you're going to encounter and how that money is going to get spent along the way. And I know a lot of folks don't, it's the B word, budget, and a lot of folks don't necessarily want to go down to the very penny or dollar on it, and that's understandably so, but it's important to at least have a general understanding of the kinds of things that you're going to encounter, because if you think about retirement as a 20 or 30 year proposition, if you miss some small expense that's out there over a 20 or 30 year period of time, that little small expense may very well turn into a much, much larger one. So one of the things that you certainly want to be mindful of is what those expenses look like and the kinds of expenses that you would encounter. So obviously, if you're planning retirement, it starts first with making sure that you've got a handle on your income, right? I mean, that's pretty straightforward. We've certainly spent many episodes of this program talking about that and helping guide people on that. Just to recap sort of the main categories, right? You want to be thinking about your retirement savings and investments. What's the distribution frequency? Am I going to do it monthly, quarterly, annually? I think most people generally will do monthly, because that's just sort of how the bills come on in. And then also be thinking about the percent withdrawal. Obviously, you don't want the percent withdrawal to be 10 or 15% on an investment portfolio, because that's not going to be sustainable. Generally, the 4% rule is what comes into play on that. Depending upon age, beneficiaries, things like that, maybe it might be 5 or even 6%. So that percent withdrawal is a big part of determining how much income you're going to get. Social Security, when to take it. Obviously, if you listen to the past couple of episodes of this show, we know that we were joined by one of our certified financial fiduciaries at Nelson Financial Planning, Rob Field, who happens to be a national Social Security advisor as well. Talked a lot about Social Security. If you missed any part of those programs, I encourage you to kind of check them out on our podcast channels. And then, of course, pension income, right? Other types of retirement, and then other assets you might have that generate out income on a regular basis, whether that be rental property or the like. So that's the income side, right? Pretty straight. I mean, not overly straightforward, but certainly things that we've talked about before on the program. And then now you would then shift to say, okay, now I got to start to think about expenses. And there's always the big three, right? The big three when it comes to that are, of course, housing. According to the Bureau of Labor Statistics, it estimates that housing is the single biggest expense for Americans over the age of 55. Now, housing means real estate taxes, home insurance, if you've got a mortgage, what that mortgage payment is. Normal maintenance, don't forget that, because stuff is going to break every year. That's the beauty of home ownership, that you've got that as a cost. So number one, housing expense, and how much is that, and how to plan for that, along with all those other things that you don't necessarily think of beyond just the regular payment. There's maintenance, there's real estate taxes that come out at the end of the year, things like that. And then number two on sort of the big three is healthcare, right? We've certainly talked about that at length before. It's estimated that $300,000 is going to be the lifetime cost of healthcare for a married couple. And in healthcare, if you're retired, you're going to consume more of it. And healthcare has perhaps the highest rate of inflation associated with it versus sort of the other categories that you would spend your money on. So certainly healthcare is a big part of it. And the reality is, yeah, you might get to 65 and be able to get on Medicare, but only parts of Medicare are free. There are the other parts beyond Part A certainly are going to cost you money. And then lastly, the third thing of the big three, taxes, right? You don't escape taxes in retirement. Of course, that's where we say welcome to Florida, because at the very least you avoid state, local, municipal taxes that you might run into in other locations, which is why if you can do that, right, then you have more money to spend on retirement, hence the attraction of places like Florida. So those are the big three: housing, taxes, healthcare, big three in terms of expenses in retirement. Then there are others, and you certainly want to get these into the mix as well. Obviously food, right? Got to eat. Groceries, but also dining out, depending upon what you like to do. Maybe you dine out more. Obviously, that's more expensive than just going to the grocery store. So you've got to sort of put that into the equation. Transportation, you're still going to need a car or whatever the case may be. Insurance, maintenance, things like that. That's also certainly an expense. To the extent you like to take vacation, and hopefully you're retiring to maybe have some fun, whether that be vacationing or doing a hobby or leisure activities, whatever the case may be, those all take money. And the reality is that anytime you've got free time, chances are you're spending money. Clothing, less so generally, and you kind of look at the trends, less money is spent on clothing when you're retired than when you're younger. Pets, well, shoot, that's a big one. Some people would be more than willing to spend money on their pets and less so on their kids. That's a different conversation. The reality is the dogs, the cats, the parrots, whatever the case may be, might very well have a cost, and then will have a cost associated with them, whether that just means just feeding them or veterinary bills and things like that. So make sure you're also kind of thinking about that. And then gifts, right? Maybe there's an expectation, or maybe you said, hey, to one of the grandkids, hey, I'm going to make sure that your college is taken care of. Understand that also is going to take money in retirement. Or you may have a kid that needs help with a down payment, things like that. Or maybe it's just the purest form of gift where you want to give to a charity, whether it be your church or some other organization. Those types of things are going to have to be expenses that you include into that mix in terms of the expenses in retirement. And then lastly, debt. The reality is that the debt should have been taken care of, because you shouldn't really be going into retirement with like credit card stuff or student loans or things like that. Understandably, ideally, you don't have a mortgage. If you do, it's still just part of the normal housing expense that we were talking about earlier. So those are just some of the things to be thinking about as you approach retirement. If you're thinking about joining the sea of people that are jumping the gun on that these days, certainly those are things to be thinking about: income and expenses, particularly some of those expenses that you might not be thinking of along the way. So with that, we're going to wrap it on up and get on out of here. Thank you all for listening to the program. Enjoy the rest of your Sunday. This has been Dollars and Cents with Joel Garris of Nelson Financial Planning.